Welcome to the Mint Diversified Funds and Market Update. I'm Kirsten Boldarin, Amplified Group CEO. Please take a minute to note the disclaimer regarding this recording. So November saw stocks hit the pause button and we saw a marked pickup in market volatility earlier in the month and a rotation into more defensive sectors before a retracement of some of those losses towards the end of the month. But even then, the rebound was fragmented with some of the larger AI stocks continuing to slide. Turning now to the macro in the US, there was a catch-up on some of the economic releases which were paused during the government shutdown, although they have announced that some of them may not be published at all. US retail sales data for September showed some signs of cooling, although it came on the back of several months of robust expenditure. And then consumer confidence, which is the chart on the left, also moderated. But on the flip side, jobs growth was stronger than expected, and weekly jobless claims fell 27,000 to a seasonally adjusted 191,000 for the week ended 29 November, which is the lowest level since September 2022, and quite a sizable difference from the forecast level, which had been forecast at 220,000. So this was certainly seen as positive. However, there are some caveats just in that there is some volatility around the number given its release is so close to a number of key holidays. In order for us to have a clearer picture on the US labour market, we are waiting on the US Bureau of Labour Statistics report, which was originally scheduled for a November release, but because the government shutdown has been pushed back to the 16th of December. I'm sure the Federal Reserve were also hoping for its earlier release, which would give a little bit more clarity on the state of the US labour market, given that the Fed is actually meeting today on the 10th of December. However, markets now are widely expecting the Fed to deliver a 25 basis point cut today. Last month, we touched on some of the socio-economic aspects of wealth distribution in the US and just highlighting how expenditure has been able to continue because of the differences in the impact of higher interest rates on older, wealthier Americans, while their younger, less well-off counterparts struggle with higher levels of debt. The other place where some of this inequity is showing up is in the so-called jobless profit boom. In a more typical cycle, what you would expect is that when profits grow rapidly, that would result in a heightened increase in demand for labour. But this has not been the case. In fact, the job market has been softening even as profits have been rising quite rapidly. So Alpine Macro, which has produced that chart there on the left, just showing the increase in corporate profits versus what your expectations would be from non-farm private payrolls. And just that discrepancy, I have described this as the jobless profit boom. But the tech sector in particular, which is where, and what they attribute this to is certainly impact of AI. And the places where you would expect that to show up is actually within the tech sector, where we have seen shedding of jobs, even as profits have climbed significantly higher. So just digging into that in a little bit more detail, what we've done is just pull cuts by industry. So just highlighting a couple of sectors where we've looked at what the job cuts were in 2025 year to date versus what they were in 2024. So the pink bar is the 2025 job cuts and the green bar is the 2024 cuts. So you can certainly see in terms of sectors, both technology and financials have seen higher job losses in 2025, even though both of these sectors have actually produced very strong profits. I thought what was particularly interesting, though, was if you have a look at the last item on that middle chart, which is government. So in 2024, government cut 38,000 employees. Whereas now in 2025, as a result of DOGE, not something that we've heard mentioned for quite a few months, the government actually cut 308,000 workers, which is quite a significant number. And that DOGE effect really shows up in the final chart on the far right, where it asks companies or agencies what is the reason for your job cuts, and DOGE was named as the top rationale for, or attributed to, with the most number of job cuts. But what we're really looking for is just that attributing of job cuts to artificial intelligence, which it does now make the top 6. But certainly as we move into 2026, it'll be interesting to see the extent to which AI is the primary driver of job cuts going forwards. Every day there seems to be a new article about AI stocks being in a bubble, and as we talked about last time, it is very difficult to know in advance whether we are in a bubble or not. To date, the 2 primary reasons that are given as to why this is not a bubble is that certainly in the technology space and AI-related space, that earnings have grown to support share prices. And the second one is just that valuations are not nearly as scary as they were in the late 1990s. And both of these items are true. So valuations are not as stretched on a technical level. Indicators point to the fact that the market is expensive, but it's certainly not beyond the extremes of history. And then in terms of sort of sentiment indicators, when you look at it, bull-bear spreads, which are used as an indicator of short-term sentiment, are not excessively exuberant. However, having lived through the 2008 global financial crisis, the 2 things that I always keep in my mind are the impact of leverage and illiquidity. So on the leverage side, there has been a rapid build-up in margin debt. So in particular, bank loans tied to the purchase of financial securities have risen dramatically. According to Alpine Macro, the combined margin debt for financial securities from both banks and non-banks has exploded to nearly 5% of GDP. And importantly, this doesn't include leverage in the shadow banking system. So this is certainly of concern. As we know, margin covering in a market downturn can generate high levels of selling pressure, and also tend to sort of exacerbate declines when they come. And I guess the other place where leverage is predominant is within the private credit space. Again, this has all been really well documented about the extraordinary increase in funds in private credit products. A piece that I read recently, which I think is really fascinating in terms of a deep dive into the intersection of private credit and AI, is a piece by Robin Wigglesworth of the FT, which really goes into detail on the most recent, largest corporate bond raise in history. So recently, there was a $27.3 billion capital raise, which went in one go to a company that you've probably never heard of, which was Baynet Investor LLC, which is a joint venture between Meta and Blue Owl, which is a private credit firm. The capital raise is to build something called Hyperion, not to be confused with the asset manager Hyperion in Australia, but rather is an enormous data center to be built in Louisiana. And the scale of this is represented in the picture above, which is thanks to Meta, which shows the data center in the context of Manhattan. Now, from an investment standpoint, I always think about going back, when we enter periods of hype such as these, I always think about going back to the main principles, which is maintain diversification, limit your level of illiquidity, and ensure that you're over over-levered. And to be fair, with those in your back pocket, you can probably suffer any mark-to-market declines and still be a participant for when the reversal comes through. So whilst we are not in a position necessarily to call whether this is the peak of the bubble or the beginnings of the bubble or at what point we are in the cycle. It does warrant some concern and does warrant some caution, and just a reflection on making sure that when you have your investment allocations in place, that you're sticking to the sort of core principles of not being overgeared in too much illiquidity, and certainly having a little bit of cash in your back pocket wouldn't hurt either. Moving on to a more positive note, which is New Zealand, which sits well away from some of those broader AI thematics, and we continue to receive encouraging signs of improvement in the macroeconomic conditions. We know we've been beating the drum for New Zealand for quite some time, but fortunately others are now starting to join in. So BCA, which is an international independent research provider, recently released a paper suggesting that the New Zealand economy is now emerging from its slump, and that is certainly starting to be borne out in the data. So the chart on the bottom left there just shows building consents on a rolling 12-month basis, which are starting to show signs of pickup. And also consumer confidence. So the ANZ Roy Morgan Consumer Confidence Index, whilst a long way off from its lofty highs of a few years back, is starting to show some signs of improvement. We are well aware that there are long-term structural challenges with respect to the New Zealand economy, but it is pleasing to see some signs of improvement, and we anticipate that we'll have a much better economic environment going forwards into 2026. One thing that we don't often talk about, just because we believe that currencies are incredibly difficult to call and often trade contrary to fundamentals for extended periods of time, is just the New Zealand dollar. So the approach that we've taken within the diversified funds is to invest on a fully hedged basis. And as you can see from that New Zealand dollar trade weighted index, over the last 10 years, it has indeed been quite painful to be a New Zealand dollar investor over this period. But the New Zealand dollar is now apparently the weakest currency in the G10 year to date, even with a soft US dollar, and also on a technical basis is the most oversold G10 currency based on BCA's foreign exchange composite technical indicator. So we know why this is. It's largely because of our weak economy, which has obviously prompted the Reserve Bank of New Zealand to cut rates, and it has delivered the deepest rate cuts out of all of the G10 nations, which is not supportive of currency appreciation. However, given much of the decline in rates is now fully priced in, on a technical basis, it would seem that the New Zealand dollar might now actually be finding a bottom. Just something to bear in mind. Right, moving on to the funds. So the Diversified Income Fund fell over the month, largely driven by the fixed income component of the portfolio. So yields rose across the curve by around 25 basis points, and this was really reflecting the global backup in rates rather than due to domestic spread widening. New Zealand and global equities both fell over the month, but we did have some highlights in our domestic names. So SRG Global continued to deliver strong outcomes, this time on the back of solid contracts announced with a number of high quality clients. Xero, however, was a detractor. Despite reporting reasonably strong results, it still seems to be wearing the overhang from the Melio transaction, which has been continued to weigh on the stock. And then moving across to the Mint Diversified Growth Fund, as we touched on earlier, sentiment in global equities had a bit of a wobble in November, just really around that AI thematic, but then staged a bit of a late recovery, but that wasn't enough to sort of close the month out positive. And then we also saw a bit of a rotation into some of the unloved defensive sectors like healthcare and consumer staples during the month. Again, New Zealand equities declined, but this was largely on the back of some of the property stocks giving up recent gains, and structural growth stocks, which is typically where the portfolio is exposed, fared a bit better. In terms of contributors to performance, we had strong positive contribution from Eli Lilly, really on the back of their announcement of potential approval of an oral obesity drug next year. Marriott International, which produced strong results, both in terms of increased EBITDA year on year and some strong international outcomes for their hotels. And then in terms of the negative contributors, those were really centered around some of those AI thematics, as we've discussed at length. So Oracle in particular sold off over investor concerns about the level of leverage that they are carrying, having just recently done a debt raise. And NVIDIA produced, again, strong results, but really got dented by the thematic, as well as the fact that Google announced its new AI model, Gemini 3. But the sort of key part of that was that Gemini 3 had been trained on Google chips as opposed to NVIDIA chips. Thank you very much for listening to our update, and wishing you all peaceful and restorative December. And we look forward to speaking to you again next year.